Hello and welcome to The View. My name's Steve Lambeth. I'm joined here in Melbourne with Oscar King, an investment analyst at Clime, like myself. And also joining us today on The View is Jason Teh, who's part of the Clime team up in Sydney. How are you, Jason?
Good, thanks. Thanks for having me here today, and I look forward to having this chat with you guys.
Well, thanks so much for coming along as well for the episode of The View. In this week's episode, we're going to have a chat about all things the August reporting season. It was a very volatile month, so we thought we'd share some observations. I'm going to pass it around. Jason's going to provide some observations, particularly about the level of volatility that played out. And we've got Oscar here as well, who's our consumer specialist, who will run through some interesting themes in the consumer space. Just to set it up at a high level, to kick off with, this slide showing the ASX on the left, the 200 pushed through 9,000 over the month of August. It was by and large a strong month with the index up 3% in total return terms. The sectors behind that all rose with the exception of the healthcare sector and information technology, but not enough to hold the market back overall. As for movements underneath that 3%, it was very volatile, and you'll hear Jason talk more about that in a moment. This is just a simple slide to set up the picture of what revisions happened to FY26 earnings as we had a huge injection of results across the ASX, and that's shown on the left-hand chart with, if you like, an array of largest revisions to the downside all the way up to largest revisions to the upside. And then on the right-hand chart, we have the equivalent share price move. And so on the left side, the upgrades, it won't surprise you, more often than not, attributed to the want of viewing a company as being able to grow. It doesn't always happen quite in accordance with forecasts. And so we only had about roughly a bit over a third to 40% of stocks have genuine upgrades to FY26. And of those that did have an upgrade, the average upgrade was about 4%. That left the majority of stocks, on our count, about 55%, had a setback to earnings, and that's shown up in that chart with a fair skew towards downgrade, some of which were very material, averaging out to about 7%. And then there was just a small amount that sat in the middle that neither had an upgrade or a downgrade. On the right-hand chart, the chart, as you can see, skews differently. It didn't mirror the revisions. It instead showed a lot of stocks able to grind higher, and in some cases materially higher. So we had roughly 70% of the ASX up, so very broad-based. And the median share price increase, I didn't use the average because it biases it up further, but the median share price rise for those stocks that did rise was 9. For the 30-odd% of stocks that fell, the median share price fall was about 6%. In terms of themes, there were a number of themes. Some of these themes are ongoing themes. Others were perhaps a bit fresher and a bit more evident in the delivery of the results. We're just going to highlight a few of these, and I've put those in dark blue. Share price volatility, the strength of small caps, the consumer environment, and I'll just make a comment as well on the Victorian economy. And at the very end, I'll wrap up with some a big picture sort of statement about what it all means collectively for our market. But on that note, I'm going to move to slide 5 now, and we're going to just dive into the theme of share price volatility. So I'll pass over to you now, Jason.
Thanks, Steve. Look, this slide highlights some of the big moves that we've seen during this most recent reporting season. On the left-hand side, you have a table highlighting the intraday trading range for some of these stocks. I mean, it is just enormous. Like normally for stocks here that deliver 20 or 30% over a year, that's probably considered a good year. Well, some of these stocks move 20, 30% in this one day, right? So, look, I guess most of them were in the small cap space, but you can see the amount of, I guess, the vicious move or the change in sentiment on the day in terms of how the market was reading the results on that particular results when these companies reported. So, look, And in fact, this results season is actually showing an increased trend to greater volatility over time, right? So on the right-hand side, you can see the volatility associated with intraday swings through every reporting season since 2022, right? So, the average intraday high for this result was just under 8%. It is actually quite extraordinary in terms of seeing how much share price can move just on results. And it's actually quite disconcerting as a active fund manager when you try to sort of assess companies based on changes in earnings or changes in earnings growth forecasts. Typically, one would have expected, like if a company reports, let's say, a 2% earnings miss, share prices typically fall around 2 to 5%, but they don't normally swing around, 10, 20% in that particular day. So Steve, if we can go to the next slide, and one highlight there for this reporting season was the extreme level of volatility that we witnessed for CSL, a market bellwether that most investors have in their portfolio. Look, at the very high level, like CSL, did have a negative earnings revision, but it was only to the extent of 2%, right? So, but the market on that particular day, the share price fell 17%. So, obviously, the amount of the changing expectations on that day was extremely amplified, and resulted in CSL derating from it's 23 times multiple to where it is today to around 18 times multiple. So it's quite extraordinary to see such price action happen for such small earnings changes, but it is symptomatic of the increasing trend of what we're seeing over time.
So just to jump in there, Jason, so I've got it right, the chart on the left shows the share price as the black line on the left-hand side, and the 12-month forward earnings is on the right-hand scale in the green-brown type color. And you're noting that despite a 20% correction in the share price, we didn't see a commensurate fall in EPS. The magnitude was of what order?
The magnitude was basically the difference between the change in the EPS and the change in prices that basically results in is massive derating in the PE, right? So the chart on the right-hand side highlights the PE multiple for CSL, which has been actually decreasing over time. But this results, obviously recalibrated that further down when CSL didn't report numbers that the market liked. And to be honest, like it wasn't that much down anyway from a EPS perspective, but the PE derating was just disproportionate, right? So which is why the stock was down plus 20% on the day.
Shall we move on to a comment on small caps?
Yeah, so the small caps actually perform exceptionally well this reporting season as well. So for a long period of time on the left-hand side, you can see the performance of small caps versus large caps. And since 2021 or late 2021, you can see large caps outperforming, and that's mostly due to the banks. The market rotating toward the banks, they're keeping the market high. Small caps have sort of lagged for a while, and obviously it's still lagging now, but it's trying to catch up. But this recent month has shown an increased interest. There's been a surge in some of the small cap stocks, and that's probably part and parcel of the increased volatility that we've seen. And on the right hand side, you see the share price change across the small cap universe, and obviously there's been more share price winners than losers, and you have some big moves that's happening at the top end, and many of those is actually related to I guess more speculative mining stocks. In Coronado delivered close to 80+% over that month because of rising commodity prices. Now when I say rising commodity prices, they're actually coming off the lows. So it's just like when we have witnessed over the last couple of months, lithium stocks have rallied quite aggressively too, again off their lows. But I guess the sentiment rolling back in the resource space has obviously lit a fire behind some of these share prices.
That's great. Thanks, Jason. Another name in that chart that's not shown but did feature in that chart was IDP Education. They were up some 60%, and analogous to your comment on CSL, it was certainly disproportionate to the earnings change. And so we seem to be in an environment of volatility in prices far beyond fundamentals, and it's become more extreme, and we assume it's due to the influence of liquidity and quant and other non-fundamental factors. So as much as that can be intimidating and uncomfortable as a fundamental investor at times, it also brings opportunity. I'm going to pass, thanks for your comments there, Jason, and insights. I'm going to pass now to Oscar, and he's going to talk us through the theme of the consumer sector over reporting season. Thanks, Oscar.
Thanks, Steve. Yeah, it was a very interesting reporting season for the consumer space. You can see on the left-hand chart, when we think about the consumer, we split it into two separate buckets, being consumer staples and consumer discretionary. The staples will be familiar to viewers. That's your supermarkets, your staple purchases in your budget. So Woolworths and Coles are the big dogs in that space, and more recently, Sigma, the owner of Chemist Warehouse, has been a prevalent name that people may be familiar with. And then on the right-hand side, you can see consumer discretionary, where this hosts a range of names where the performance throughout the month was much stronger than what we saw in the staples sector. Now, when we think about the discretionary space, it is much more of a growth space relative to staples, which is considered far more defensive. And what we're seeing through the reporting season for FY25 was actually the first sign that the consumer in Australia has started to improve. And evidently that was represented in the first trading update for the first 8 weeks in FY26. And that was something that the market bought into against the backdrop where the ideal for the Australian economy is improving with declining interest rates, inflation coming down or stabilizing. You have an improving backdrop for real household disposable income following that decline in inflation, and then wages growth, which now actually prints a positive number on a real adjusted basis. So if we move through the examples through reporting season, and one that would be familiar to the viewers and probably one that is held across most viewers' portfolios is either Woolworths or Coles, being that defensive dividend play stock. It was a very stark result. It's probably the biggest difference in result that we've seen for some time, with Woolworths having this halo premium rating on it versus what historically Coles has. And that's largely in play being driven by Woolworths' greater network, their bigger online business, but Coles has made some significant improvements to its capabilities over the past 5 years, where they've invested a significant amount of capital into automated distribution centres, customer fulfillment centres, where they've partnered with businesses like Ocado, who've run these successfully through other geographies in the UK. And ultimately what we saw is a bit of a divergence where Coles was benefiting from cost efficiencies, improvements in stock availability, and ultimately that translated to higher sales growth and better EBIT margins, whereas Woolworths over the past year in FY25 had a tumultuous time dealing with the disruption from the industrial action that occurred earlier in the year in 2Q25, and then later having to deal with the ACCC regulatory overhang, which ultimately, in the eyes of the consumer, had lost a little bit of trust from a price perception perspective. And as a result, we're seeing Woolworths now going on this journey of trying to regain the trust of the consumer by reinvesting back into price, reinvesting back into that fresh food option that they are known for, and ultimately trying to improve that customer experience in store by refreshing the store footprint. we'll move to the next slide, which ultimately shows, well, how's the market treating Woolworths versus Coles? It is saying at the moment that Coles is superior to Woolworths. But the question as analysts at Clime, and as you would anywhere, is asking the question of, well, how likely is this to persist and why is it likely to persist? And when we think about this over time, the chart on the left shows the like-for-like sales between Woolworths and Coles. And ultimately, it shows through history that they've largely been joined at the hip. They do at times go through cycles where one outperforms the other. But ultimately, at the end of the day, they typically come back to trace there or thereabouts, because it is all about what is convenient for the consumer. The consumer will end up going to the supermarket that is closest to them. And historically, that has been likely a Woolworths because they have a greater network footprint. However, in more recent times, Coles, having made these improvements, is seeing the benefits flow through from an EBIT margin perspective, which we can see on the right-hand side, where FY25 represents the first time where Coles is now printing an EBIT margin above Woolworths, and hence the share price move that we saw on the day for Woolworths versus Coles was a very stark difference. Woolworths down about 14%, whereas Coles was up about 12% on the day. And subsequent to that, we've obviously seen some earnings revisions to the negative side for Woolworths, and then to the upside for Coles. But similarly to what Jason was saying around observations of earnings revisions versus share price reactions, the market is extrapolating these earnings revisions and basically dragging right on your Excel model to extrapolate what the returns are going to be for these businesses into the future. But as I just mentioned, largely what we see over time in the consumer staple space, it is much of a toing and froing. And we're now sort of asking the question that what's being implied by Woolworths market cap is probably unlikely to persist when we think about this from a more longer term perspective over the next 3 years. The next slide is a representation of the consumer discretionary landscape. And I won't go into too much detail here, but you can just see some names on the screen like Temple & Webster, Adairs, Universal, Harvey Norman, Nick Scali. These businesses that are exposed to household goods had a very, very strong start to FY26, likely driven by those factors I mentioned earlier, where the macroeconomic backdrop for Australia is improving. The market is extrapolating these sales numbers and thinking that, hey, things are getting better, therefore the growth outlook is improving. And therefore, we've seen a re-rating in the earnings profile of these names. And subsequent to that, it's been a very strong start to FY26 for the consumer sector in general. I'll now move to Victoria and hand over to Steve just to provide some comments on what we're seeing, I guess, as a representation of Victoria's strengths or weakness versus the rest of Australia.
Thanks, Oscar. Yeah, this is sort of intrigue and slight amusement, but I feel like it's important to put it into the mix as part of themes. A number of CEOs stood up and made known across the nation, whether industrial businesses, energy businesses, retail businesses, that if there was one weak spot that's not firing, where Oscar just alluded to an improving consumer backdrop, there was GDP data out yesterday to make known there is strengthening private demand, begging the question what sort of rate cutting cycle we'll get, shallow or deep. The one area of our economy geographically that's letting the side down remains Victoria, and we did have a number of CEOs all make references to this market, references to the challenge of demand, references to the challenge of productivity, references to the challenge of constraining problem loans. That's what's shown in the chart down the bottom. 90-day arrears for Victoria in the green were once just in the pack, and now they sit above all other states. We also have on the chart on the right another data point being unemployment, which isn't sheep stations above Australia, but nonetheless is another sign that Victoria is a laggard economy and has some wood to chop in order to get back to the broader trends. Let's now just move to the last slide and we'll finish up. It's a slide to try to pull together as much as we've covered ground across some of the goings on in retail, goings on in small caps and so on, we do have a very concentrated market here, and we do by and large make reference earlier on that on balance, we haven't had a reporting season in which analysts have been prompted to increase forecasts overall. If anything, they've moderated their assumptions, and that leaves us with, on the left-hand chart, an earnings per share worm, a 12-month forward earnings per share line that remains flat and has been flat for several years now. And so that creates somewhat of a challenge and leads to our last slide, which is a picture of the rating of earnings. So earnings flat, as I mentioned, the rating of our market, the PE ratio of the ASX 200 has pushed through 20 times. The history we've shown here goes back 20 years. So we are really at altitude and at a high end. And our interpretation is that because earnings aren't really wowing us collectively, it must be due to other factors. It would be liquidity. It would be the anticipation of rate cuts. But of course, given some of the commentary we've made, the improving consumer, for example, as I mentioned, private demand data from the GDP output yesterday was reiterating an improving housing spending backdrop. And also in the top right chart, the picture of an unemployment rate that still sits south of where it was pre-COVID does beg the question, will we have further policy cuts that proves to be a shallow cutting cycle, or will we have a more conventional and deeper cutting cycle? And that does create, from our perspective, a reason to be somewhat cautious and somewhat defensive on the path forward. Again, given earnings are relatively steady alongside a multiple that's relatively full. We're going to stop there. We've just ticked over 20 minutes. Jason, thanks so much again for joining us. Oscar, as always, thank you. We'll leave the view there. Thanks for watching, and we'll see you next time.